I love it. I always come to the so this is only my second time at a Future Proof event. My first time was in Huntington Beach this past fall, and I was just talking to Nick about how the playlist is something where I kind of get a little bit excited. For anyone who's ever done gone to Walt Disney World recently and done the Guardians of the Galaxy roller coaster, you know how they set it to a soundtrack, different song for every time everybody goes on there? It kind of feels like that to me. But anyway, that aside, I'm burning time, and we want to get right to the conversation. Robyn Grew, man, thank you so much for sitting for this little fireside chat, even though there's no fire right now.
There's no fire, but I can see the sea for the first time.
I can see the sea as well.
Excellent.
I see the sea. I see seashells by the seashore.
Okay, you can see.
Yes. So, Robyn, maybe we'll start off because I always want to kind of keep these things a little bit more loose and to the moment. Uh-huh. And one of the things that we just did on the halftime report, which you just shot over here live at the Betsy Hotel, was talk about the market volatility that's permeating today, just specifically. We're seeing this kind of continuation of this near-term volatility that we've done.
Yep.
And I'm kind of curious, Robyn, if you're the CEO of the world's biggest publicly traded hedge fund company, what exactly are you doing given all the volatility right now?
Why am I sitting on a stage with you, Dom?
Yes, how are
okay.
you not back running all this money and everything else?
So we're not near-term traders. I mean, I think that's the point. One of the things we learned, and we all did, right, was the GFC with the people who came out of the market and didn't stay invested. They didn't do so well in this. So volatility is something you navigate. It's part of our world at the moment. It's something that's most interesting and perhaps is one of the reasons why this conversation is quite useful, because as you see volatility, as you see dispersion, as you see markets bifurcating away from one another, whether that's in Europe or in the UK or in the US or in Japan or anywhere else, ever were it thus the case that you need to think about alternative investments and broadening portfolios and orthogonal content, uncorrelated content, so you can navigate this volatility.
What exactly then does it mean if you are, I think there's a certain connotation for hedge funds and traders. We think about all the movies and books. We think about billions, for instance. We think about that kind of thing. And we just automatically gravitate towards this idea that there is just trading all the time. These guys who are just buying and selling, moving around, high speed, everything else. But you told me just the exact opposite right now. It's a little bit of an antithesis, right, about how things are viewed with regard to hedge funds. Is that the way it's always been, or is that just the way that man has evolved in the way that it treats an alternative type investment?
That's a great question. Listen, I wish for my 21-year-old son's benefit that it was like billions and I was driving very fast cars and doing exciting things. He's really disappointed when he works out what I actually do for a living. So it's an evolution for sure, and there are strategies that have faster trading cadences than others. But the reality for all of us is about thinking that alternatives was this kind of niche thing that only somehow the very wealthy or the institutional world got access to. And I think what's interesting about the conversations that I'm hearing today and around this venue is, what are we doing to actually service wealth and this ever-increasing segment? How do advisors differentiate themselves in the offering that they have for their clients? And how do they come in and knocking on my door and saying, hang on a second, you're doing all of this stuff with allocators that control trillions of dollars all around the world. You're responsible for helping them navigate 401ks and IRAs and savings plans and annuities and endowments and all of this stuff. How come I can't get hold of that for my clients today? So you're right, we're not quite that fast and loose. I think the other thing that's the misnomer here is that we're just making rich people rich. We're not. In fact, the majority of my business is about serving real people. It's about teachers in Texas. It's about metal workers in Holland. It's about firemen in Japan. It's about real people at the end of the day, and we turn up to work every day to serve them. It isn't just about making a lot of money. I've said this before about Man Group. You're never going to find that you turn up tomorrow and find in the headline that I bought a sports team. We don't do that at Man Group. That's not what we do. We come into work, we manage money, we care very much about performance. We're trying to be as relevant as we can be to people who are navigating the most volatile and dispersed markets that we've seen for quite some time.
If that's the case, there has then been perhaps an evolution of how the hedge fund industry has operated and continues to operate today. If, in fact, that is the current construct by which man operates, and by extension, perhaps other funds in the business, it is also different from an accessibility standpoint. I mean, you've always serviced institutional clients, pension funds, things like that, and that's how, by extension, you get the real people in the real world, firefighters, policemen, teachers, and that sort of thing involved. But these days, there is an increasing amount of access provided towards people who have not been traditionally pension fund managers, large institutional investors. Is that a good thing or a not good thing?
I think it's a great thing if it's done properly. Like all things, 20% of the AUM at Man Group is indirectly, we don't go direct to wealth, but in the hands of wealth, right? If you do it right, if your advisor is good, if the platform spends time with people and understands what their risk needs are and what their portfolio needs to look like, it is a good thing. The more content you can provide, the same principles about portfolio construction are true. Institutions don't have one bet. They have diversified portfolios that they're expecting to work, some of those content pieces to work in some markets, and they work and don't work so well perhaps in other parts of the market cycle. It should be the same for wealth. That these are not just opportunities and portfolio construction ideas that only work for institutions. The smartest advisors out there give access to your clients. You're giving access to portfolio construction and risk management capability. That's what we do. We're completely aligned with the product as a product provider in providing you with content that works for your clients. And because we're a liquid alts provider, we're held to account very simply because if people don't like performance, they come out. And if they do like performance, and it does what it says on the tin, and it's used accurately and smartly within a portfolio, then it's a good thing. And I think in this day and age, surely we should be just doing a better job every single day for clients.
What exactly then is the biggest hurdle you think facing not just your side of the business, but some of the investment advisors who are now looking at putting their clients into alternative investments in a bigger way, that they are allocating to them not from a 1 to 3 to 5% level, but maybe even more so, given the fact that the return profiles and the non-correlative aspects of certain alts are now becoming more attractive for certain types of investors?
So I think the challenges come in collateral, come in the education process that you need to have. And it's about understanding what those products do for you in certain markets. Institutions have a lot of that collateral. And I was talking to very large platforms, some of whom are represented here across this beach. It's an odd statement to say, represented across a beach. Anyway, that aside. And it's about making sure that we treat product providers like Man Group, treat platforms and wealth managers the way we treat big institutions, that you get access to all of the additional capabilities that we have in portfolio construction, in risk management, in collateral, in research, and in the reporting that we do that says, listen, if you have a portfolio that looks like this and you need to fill a gap, or you want returns in a certain format, or you need to use equity in a more thoughtful way, we can do that. It comes and it looks like this. And this is what it should do in a particular market cycle. So I think it's education. And I think that's something that we have to get better at doing.
What exactly has that education profile looked like in your mind with regard to the RIA world that you are increasingly more involved with? How have the conversations changed over time, not just since you've been the CEO of Man, but also before that? Have you seen a kind of progression or evolution for how that involvement with RIAs has changed in, like, say, the last 10, 20 years?
I think what we've seen is, because we're global, we get access to all sorts of clients from all over the world. And what we've seen is a greater pickup in Asia Pacific, perhaps, sooner than pickups perhaps in parts of America or indeed in Europe, where there's been a sort of nervousness about alts. What I think has changed dramatically is things like crypto. So all of a sudden, we had a bunch of form filling and a bunch of thingy bobs here, and you had to give 1,000 pieces of documentation over, and goodness only knows what. And we still do. But if you want to open a crypto account, 3 clicks and you're in. And I think that's the changing dynamic, right? I think social media, completely different thing. I think we educate people differently. If you ask my son, he's not a good bastion of many things, but if you ask my son to look up something or to do something, he doesn't go to the instruction manual. He Googles it and he YouTubes it. So I think the way that we should approach markets and the way that we should approach educating people has to change. I mean, we have had a relationship with Oxford University for the last, let's call it 17, 18 years. And we have the most extraordinary research papers that come out of that space. And if you've got a spare few hours, you can read them. Sometimes.
Few hours. I'll take the over on that.
Then you can read them, and some of it you might understand. I mean, there's a bit of that. I think there's something valuable about the uptick in podcasts. I think there's something valuable about the YouTube consumable. I think there's something valuable about us recognizing that the world has changed, and education needs to change, the way we talk about things has to change. And it isn't a great mystery. I mean, we like to think about ourselves as very smart. Well, and sometimes people who work for me are very smart, you'll be pleased to hear. But actually, our skill is about making that accessible. And how we do that, I think, has changed. I think 10 years ago, we didn't think about it at all. I think the last 5 years, we think about it a lot. And I think finding ways of making this meaningful and readily available in a space that is consumable by not just the end client, but the advisors that sit here today, I think that's important.
I think in my time watching and being part of the markets, I've seen, at least in the past 20 years, a change in the conversation with regard to accessibility of these types of products. Just 20, 30 years ago, these were only for accredited investors. There's still a hard, fast kind of definition of them, but the idea was the same. The idea was this was left for a small portion of the population who could understand the risks, challenges, nuances, and benefits all weighed together and could afford to even lose some of that money and not be financially devastated by it. In the past 20 or 30 years, there's been a massive move to democratize, for lack of a better term, the markets, open up accessibility. Do you feel as though that effort, now personally, as a former markets guy and a current reporter, I love the idea of accessibility and giving people accountability. But there are those who believe that safeguards need to be in place because of the nature of the type of product you traffic in. Do you think that democratization of markets overall is a good thing, even if it means some people could lose money at some point?
I think the premise that they're not going to lose money in long-only equities is not correct, right? Look at the volatility. We started this conversation with the volatility.
The NASDAQ is down 13% from its highs right now. Right.
So if you're thinking in that world, if you are only invested in long-only equities, you're experiencing some volatility now and potentially without any downside protection. Is that right? I don't think it is. So I do believe in accessibility. I don't believe it comes at zero risk. I also don't just provide long-short product. So, do I believe in active investment? As indices get more and more concentrated, do I think that's ever a more valuable time to start with active equity investment? I absolutely do. So it isn't just that I'm selling or thinking about long-short product. In fact, can I go back a bit? So Man Group is, let me, for those of you who are less familiar with Man, we think about ourselves in sort of 3 distinct areas, right? We have a very large quantitative trading capability. That's all the way from CTAs and macro world, all the way through to long-only equity, right? We have a discretionary or fundamental piece to our business. And then we have the third piece, which is the bit that we talk about more and more, which is a word that's overused, but I don't have a better one. So if you've got one, please let me know after this, which is solutions. Now, effectively, 2/3 of our AUM has some form of customization or solution attached to it now. The most concentrated, the most let's sit down for 2 years and work out a brand new product thing, is about, I don't know, let's call it $15, $16 billion. But $100 billion of our assets are in some form of customization. And that's facing institutions. So why does that matter in what I'm talking about? It matters because what I do all day is think about content. I think about what's in the larder that I can build into something that actually answers and addresses the questions and the challenges that institutions and platforms are facing. Now that's important because in answering your question about democratization, it allows us to work with platforms to come up with content that is right-sized with the right risk profile to answer a gap that sits within the offering that they might have. That's why it's important. And Man Group is on a single mission to do that. So as much as I can give you a CTA trend following, I can give you a highly levered piece of business, I can give you a straight discretionary long-short fund, I can give you a multi-strat, I can give you a multi-strat that has access to 75 strategies, I could give you a credit multi-strat, I can give you access to private credit. What I can give you is a shopping list. And what I can do is work with you to make sure that we deliver something that you want. I'm not here going, I have this fund, anybody want to buy the fund? That's not what Man Group's about. And so that is why I think your question about democratization being a good thing, it is, but it isn't about just increasing a list of content that somebody can throw a dart at or something like that. It's about working with people to say, what do you need? And how do we solve that problem with you and for you, for your end clients?
Okay, so my question then to follow up on that would be, in a world where there are ever increasing numbers of options for people to invest across alternatives, whether it be private credit, private equity side of things, whether it be with hedge funds, real estate, everything else, there then becomes way more bandwidth that's going to be required in order to figure out whether or not certain investments meet the criteria that investment advisors need. Man Group is very different than some hedge fund with $100 million in management and a product that they think that they want to pitch. It sounds like the scale that Man Group operates in is a benefit because you can do all those things that you said. But that is not true of the entire alternatives space. Man Group is an outlier. It's one of a handful of companies, relatively speaking, that has that kind of scale. Does that then mean that you should only be looking at certain types of scale alts that provide that kind of education and product knowledge with management as well?
Well,
that's a lot, I get it.
That was a lot, and there's a very simple answer, which is yes, but that would be wrong, wouldn't it? I mean, I'd be talking my own book a little bit too much. What is good for our industry is entrepreneurial creative content. What is good for our industry is that it's really hard to find alpha. I'm an alt shop that looks for alpha. I'm not a passive player. I'm constantly on the hunt for alpha, and alpha deteriorates really quickly. So when people say to me, what makes you not sleep at night? And I go, well, performance. And then they say, and the second thing, and I say performance. And then they say, okay, Robyn, this is dull. What's the third thing? And I say, it's the hunt for alpha. It's really hard to find outperformance. It just is. So do I think delivering outperformance at scale is important? Yes. Have we learned in our quest for more content that we can get very excited about something that has absolutely an uncorrelated return stream, but you can only put $500 million to work on it? Yes. So there is something about being able to deliver outperformance at scale. And there is something about the fact that, listen, for the last 6 years, we've spent over $120 million on technology. That's comp costs, that's compounded with 30 years, 35 years of quant capability and data science capability. That's a lot to be able to leverage from. There is a reason there is consolidation happening in our world. There's a reason why the big institutions don't want to face 100 different managers, right? So there is something to that point, but also let's not make the barriers to entry such that we don't and we crush entrepreneurial, creative capabilities that then someone like Man Group can leverage and make whole.
Fair enough. I think one of the comments that we heard just in the last couple of days, Edmund Murphy, who a lot of people know here in this group, he's the CEO of Empower, right? Retirement, one of the second biggest retirement services provider in America right now. And so when we talk about that, that's 401ks, right? That's kind of the ultimate democratization, I guess, construct for investing for the American public. It's taken over defined benefit. Now there's this, massive move towards getting people more involved in investing for their own future. With that being said, he also thinks, he made comments to CNBC about it, that there should be more access to, he was speaking about private equity, but just alternatives in general, accessibility in people's 401k plans. Is that a good or a bad thing?
I think, as we've said earlier, I think this is about knowledge and an understanding of what these products do. So if this is about trying to ensure that you are managing downside risk, I think that matters. I think it matters whether you're 22 or whether you're 62. I think those parameters of what it means to wealth manage is in the hands of the people sitting in this audience. I do something different. I provide the access to the product that could work for the 22-year-old or could work for the 62-year-old. And I think the danger is that we think about these things in this binary format. It isn't a one-size-fits-all. It's a depending upon where you are, depending upon what your wealth looks like, depending upon your wishes, depending upon whether you've got a legacy piece here, depending upon your health. There's so many different parts, which is why I don't face the wealth market directly and why I think about, surely it's about access to content that gives you flexibility to create your portfolios. Surely that's what this is about. Surely it's about risk management. Surely it's about using technology to do better things for your clients. And then surely it's about keeping people like me on my feet so that we provide you with the content you want. So it's a single person needs to run through a whole process of what do you want, where are you, what's your current liquidity, what's your current wealth, what do you need out of this portfolio? It's a slightly more nuanced question than I can say, and the answer is 401ks should all have access to X.
You mentioned before, and you kind of touched on it here as well, the kind of investment that you have to make in getting the product a little bit more front and center, understanding about the changing way in which money is managed, especially when it comes to things like alternative investments. One of the biggest themes, of course, that has developed over the course of the last several years has been the massive ramp up in artificial intelligence and machine learning as part of the financial construct. I would beg to say that we are well past robo-advising at this point in terms of how technology is going to be possibly disruptive. And one of the themes at Future Proof is to future-proof, right? To try to figure out how you can not just survive and thrive in an environment where things change as rapidly as they do. Has AI, the ramp up of technology, changed the way that you and that Man Group operate? And how exactly has that changed because of how quickly things have developed?
Not surprisingly, perhaps, we've been using AI, and all of that means machine learning, large language models, so on and so forth, for a good 10 to 15 years. But we use it throughout the organization. So you will find that for execution capabilities, we have our own machine learning algos that we drive for execution. When you're a, let's say, $7 trillion print on markets, you end up wanting to execute and make sure you don't lose alpha in the execution modeling. When you think about it in portfolio construction, we use AI and machine learning. When we think about large language, I mean, millions of pieces of data. We created our own capability in that space, and that's now part of Bloomberg's offering, ArcticDB. When we think about accessing markets, we now trade over, let's say, 800 markets. This is about the scale and capability you have to deploy technology. We're always going to be early adopters of tech. I have an open architected firm. So by that I mean, the reason we are able to attract some of the smartest quants, data scientists, technologists, developers, engineers, because we give them an open playing field. So we participate in and share content and code in this wonderful thing called open architecture. You get a GitHub. Ever heard of GitHub? If you haven't heard of GitHub, look at GitHub. Fantastic. It's a bit like Travelocity, but for technologists. You get rated on the content and the provision and the coding that you've got in the larger environment, right, outside and beyond your firms. We are regularly given those sort of 5-star GitHub ratings. So we use technology to make us better. At one point, 2 years ago, the biggest user of robotics in Man Group was in operations. Since 2018, we've doubled our AUM and not increased the number of people we have in ops. That's a function of tech and capabilities and AI and robotics. Of the 50-plus languages that we all speak at Man Group, I speak one and I do it in this accent. Yet the second most used language at Man Group, we jokingly say, is Python. So you will see lawyers and finance and technologists and quants and discretionary managers using the capabilities of our tech. Do you honestly think that we don't run, when I stand up in our annual reporting, which I did a few weeks ago, we ran the script through sentiment analysis, of which we have 3 different, 2 that we run through external providers, 1 which is a homegrown version, to make sure that what we're trying to say lands in the way that we think analysts should pick it up. And do you think that our discretionary managers now have to read the thousands and thousands of reports on their underlying investments? No, because we deploy tech at it, and we deploy large language models at it. So it becomes an innate part of who we are and what we do, and it's absolutely an enabler. Now, what we don't do is rely on it at the moment to make investment decisions, and I'm not sure that's coming anytime soon. But the skill of having 650, 700 people at Man Group who self-identify as technologists or as engineers or as scientists or as quants is not only do they love new tech capability, but they also know when it's not going to provide something. They understand the risks of it. So they're not surprised by hallucination. They're not surprised that they can trick it. And in fact, for the first little bit, as we had Man GPT, one of the fun games was, look how we can trick it into saying the wrong things. And that, I think, is healthy. So big adopters of early tech, every day of the week. Enables us to do really good things, better, faster, yes. Do we use it for co-piloting every day? Does it allow us to backtest quicker? Yes. Does it give a whole bunch of people through our organization superpowers? Absolutely. Making investment decisions anytime soon? Not so much.
Okay, so if that's the case, how comfortable do you think it is for the customers that you face, right? Whether it's those institutions, registered investment advisors, those advisory firms, wealth managers, do you feel as though there's a level of comfort or discomfort that comes along with how much you use those technological solutions and how it impacts those clients? Not necessarily the individuals themselves, but the people who are actually facing those ultimate end clients, the investment advisor
How
reps
comfortable
that
are they?
doing that. Yeah.
So there are a couple of things we say at this point. One, we're a quant house, so our clients tend to come to us and ask us for help. So a week and a half ago, one of the large US state plans actually emailed me and said, hey, Robyn, I'm having real trouble being able to get an AI solution that helps me aggregate and sort some specific content and data. And they said, we've been battling with it for the last 6 months. Can you help? And I said, sure. And I sent them 2 technologists to have a conference call with them, and they now have a solution. So actually, people come to us for help. The other thing we do is this. We say, how many of you travel in planes? Lots and lots of people travel in planes, especially in this country. It's almost the only way you can get anywhere. And then I say to them, and how much of the, by percentage terms, how much do you think the pilot pilots the plane? It's about, on average, 5 to 6% of the time.
It's all autopilot these days. A computer does it, right?
Computer does it.
The open and the close for the markets and the takeoff and the landing for the pilot.
Kinda, right? So the point is, we use this, I mean, in your pockets, probably in front of you, in your large-sized computers that you now travel around with all day.
I've got 2 of them.
I'm just saying, I knew you would. So the reality is we rely on this technology all day long to do everything. We don't book a restaurant, we don't order a cab, we don't get on a flight, we get annoyed when the British Airways app, which I can say here, never bloody works. I shouldn't say that, it's a very good app. Anyway, but the point being that actually this is in our lives already. It's here, getting comfortable with it, being less trusting of that than an advisor who says, let's go into a tracker fund. Why is that good? So actually, this is about a tool. We don't use abacuses anymore either, or is it abaci? Anyway, we don't use those. We use calculators. We don't think that's a bad thing. I don't need to know how a scientific calculator works. I do know that I can use it. That's the point. And so that point about understanding what technology can do to make you better, faster, smarter, can take away the commoditized content that you get dragged away from. And you can use it to be better, to add the alpha, to be alpha-driven yourselves. That's cool, and that's what people should do.
All right. We've got less than 10 minutes at this point now, and I could stay up here forever talking with you about this, but I know that you also have travel plans yourself, and the audience has their own plans. I would like to take the last few moments here to give our audience some takeaways with regard to how, as investment advisors or people who work in RIA ecosystems, how they can go about engaging with alternative providers in a more productive way, given kind of the fact that the whole world is changing so rapidly around them. What exactly is the best way to access your expertise, your products, and everything else in the most efficient way possible?
Call us. Put us to task. Make us work for you the way that other institutions make us work for them. I mean, it's as simple as that, right? We also have roots in the fund of funds world. We know how to construct portfolios. We have tools and we have capabilities. We have collateral, we have information, and we can make you smarter. And you can make us smarter by telling us what you need. So engage with us. It isn't that difficult. We've got a website and everything, but also we're real people. And we're aligned with you. We're not actually fighting you for your business. We're trying to make you better and give you more collateral to do more with it. We are willing and we want to share our skills. We are willing and we want to hear what we need to do for you. And the only way that you get that is in real conversations. And it's why we've had strategic partners across the institutional allocation world for tens of years, because we're on a journey to be valuable as a partner to them. It's why that CIO picked up the phone and said, I've got a problem with my AI, can you help me? It wasn't about, can you give me a product, or we've got this particular issue, or what about performance? It was I've got a problem with my AI, can you help? And that's what you need to do. You need to find providers, in my view, that are willing to come to the table, who are willing to deploy what they do, and they do with institutions today. And you need to make us work for you, because that's what we're here to do.
Okay, if that's the case, what do you think is going to be the biggest, trend, product development, initiatives that you will take on in the coming, say, 1 to 3 years to expand your presence into the world of asset management, investment management, high net worth, ultra high net worth. How exactly do you see Man growing into those products, and what exactly do you think strategically you have to do to separate yourself from the competitors you have out there?
That's a great question. You know, we've learned, and we continue to learn. We'll stay humble in this regard. So, products are changing, right? People want ETFs and active ETFs. You want them. That's what your clients need. So we'll build them. You want separately managed accounts, or you want products that you want to white label, we can build them. We do, and we have. You want interval funds? We can give you that. You want different liquidity provisions on some of those quasi-private businesses? We can do that, because we have that. So I think what we will continue to do is build out that larder, because content is king. We'll continue to drive for outperformance, for alpha, for active management. We'll continue to build, there's a reason we're now 35 billion in credit, right? Because clients wanted it, and we shaped that in both public and private, right? There's a reason that we think we have value to add in these spaces, but we're also flexible. So that operating platform that allows me to deliver everything we do with basically no OPEX spend on some of that liquid equity or long-only business, I can deliver that to you at scale at the right price points. So I think this is about recognizing that we don't come with one thing. We don't come with one fund. We don't come with one strict way of looking at something. We come with a capability and a passion to deliver outperformance and to help do that for you and your ultimate clients. So we'll keep nimble, we'll keep humble, and we'll keep delivering.
Okay, we've just a few moments left here, a few minutes left. I would like to kind of help conclude things right now by giving a little bit of your kind of macro thought and commentary about what's going on right now.
Yeah.
I'm not asking you to put a price target on the S&P or the NASDAQ. I'm not going to whatever. But I will ask you, as the chief executive of a massive hedge fund group, what's happening in the markets right now is catching a lot of people's attention, myself included. I get asked a lot, even just in the last couple of days, with regard to, what I think is happening in the markets. Not that I have any expertise at all. You're the one with the expertise. So I wonder, from where you sit, is the global economic environment one where you feel as though things are still ripe with opportunity, or do you feel as though you have to be a little bit more cautious and opportunistic with regard to how you perceive the markets?
Can I say both? So both, right? Volatility. So let's go back. Absent the last 2-3 years, we were in this benign environment. We had a decade of, if you were an asset holder, you did fine. You might have wanted some risk adjustment in that. You might have had just a few less bonds, maybe a few more equities, whatever. Maybe a lot of tech, I don't know. But if you were an asset holder, you did just fine. And then inflation got out, right? And once inflation is out of the bag, really difficult. So inflation has been hard. Interest rates, we're now in an interest rate environment. I'm old enough to think that 6% isn't too bad. Anyway, but there are plenty of people who think that 6% is pretty bad, right? And then you've had this bifurcation. If you look at the indices, they're different. The constituents are different. The US indexes, really different from the European ones. And then you had half the world's Western population going to the polls. And by the way, we've had 2 wars, and they're continuing. And so the macro space is kind of interesting and tricky. So what can I tell you? I can tell you this. Volatility is a thing, and I don't think that's going away. And dispersion is a thing, and I don't think that's going away. And I think we may be in a position where you're going to see some countries in recession, some in stagflation, some in an inflationary world. You've got quantitative easing coming back in. Who'd have thought? Growth in Europe. I mean, the last 50 days...
They are outperforming the U.S., by the way, by a lot so far in 2025.
The last 50 or so days have presented the world with some other challenges, right? Tariff environment. It's... So what I can tell you is this. I have no idea that I can predict what's going. Well, I know I cannot predict, and in fact, every major bank that's sitting at that end of this speech, we're all struggle with predicting what's going to happen in the next year to 3. What I can, I think, give you some certainty around is you're not in a benign environment. You're not in an environment where all assets are going to appreciate. You're not in an environment where you can ignore volatility or you can ignore dispersion. You and I were chatting, and it's a rare thing, and I think I can say this, but I was talking again a couple of weeks ago as this volatility and this dispersion was really picking up. And somebody said to me, a little like you started, hang on a second, are you really worried? And I said, no, this is the moment where, and I use this phrase, and I'm sorry because it's been overly used, where you keep calm and you carry on. Now, I say this with a British accent, and of course it did come about in 1939, and it wasn't used, by the way, in 1939 very much at all. It was rediscovered in 2000, ironically. But there is a moment where calmness needs to prevail, where you need to take a step back and think about risk management, where you need to work out how you're going to manage volatility and think about that dispersion and how you want to engage. And liquidity is important in that, and you do need to be dynamic, but you don't need to panic. So keep calm, carry on.
All right, with that, thank you very much. Robyn Grew, CEO of Man Group, we appreciate the time and effort, and thank you very much, and I look forward to chatting with you more in the future because I have so many more questions. Thank you guys very much.
Thank you.